Welcome to the Killik Co podcast for the 23rd of June. Last week we saw a relatively quiet and benign financial markets. We certainly heard from the FOMC and their decision on US interest rates and the discussion around it. And really the interpretation from that meeting was that the Fed remain quite dovish towards financial markets. And really the focus, of course, is how is the US economy rebounding from that really quite difficult start to the year. Weather-related impacts on the economy led to a very sort of flat market for the first 3 months, and the US economy needs to see quite a strong rebound in the second quarter to have some hope of meeting its revised down expectations. US economy was anticipated to grow by close to 3% at the start of this year, but already those numbers have been trimmed back to around 2.1 to 2.3%. So again, some of the forward-looking data that we're seeing as we approach the end of the second quarter, things like US PMI, for example, need to come in with some fairly solid numbers to give heart to that second quarter data. In the UK this week, we will have the third reading of the first quarter numbers from the UK, and there is expectation that we'll see a small tick up in the estimate from 0.8 to 0.9%. These numbers constantly get revised. It's not just over a few months, indeed they can be revised over a few years, but as more data comes through, and in light of the recent construction data, the feeling is that the UK economy may indeed have grown slightly faster in the first quarter than was expected. It means that we're probably on a run rate of over 3%, at about 3.2%. And again, this is leading to a number of the MPC members now coming out suggesting that rates will have to go up sooner rather than later. The latest is David Miles in the Telegraph today. In terms to the morning news, we've had the reaction to the fire that took place at the Asos distribution centre up in Barnsley, and the company has noted that around £20 million worth of stock was compromised by the fire over the weekend, but they've moved very quickly, and that they are already taking orders from their new website as of 2 a.m. this morning. So the reaction in the share price is less than anticipated when this news first broke over the weekend. Just a quick glance at some other items in the diary for the week ahead. In Europe, we have data. This is the German IFO data coming out again. The focus here is, has there been any bounce back in the European markets or expectations for markets on the back of the recent move by the ECB to lower interest rates. Again, we'll take a look at a chart of one of our recommendations in the European space later on in that time. In terms of the company results, we have Imagination Technologies reporting their full year results as of tomorrow. And later on in the week we'll also be hearing from the sports manufacturing group Nike and regarding their Q4 numbers. Just a few charts which we think are relevant to the current environment, and that more dovish tone from the Fed certainly kept the S&P moving higher, hitting record highs constantly during the course of last week, nudging up towards that sort of 2,000 level on the S&P 500. That's certainly getting close to full-year targets from some of the leading investment houses at the moment. So very strong performance from the S&P. Certainly not reflected here in the UK. In the UK, we're still struggling somewhat to make progress towards that sort of 7,000 level. The other driver is oil. Oil has been on a bit of a sort of move up after trading sideways for many months now, breaking out on Brent now up to around 115. And you can see on this chart here that is sort of quite close to a top, and the net result of that is that the oil stocks continue to sort of break higher. BP, as you can see, having sort of flirted with 500 pence now on numerous occasions. Actually, if I date that chart back further, you'll note 500 being a little bit of a cap. Well, it's breaking through that now quite convincingly up at around 515. And similarly with Royal Dutch Shell, a little bit of a pullback recently, but it's resuming the upward trend there at the moment. And the market sort of additionally cheered with Royal Dutch Shell by the disposal programme, which continued last week with the sale of a stake of its Woodside Petroleum stake. Killik, which has bought sort of year-to-date disposals at around sort of $12-13 billion, so it's well on track for their target. The pharmaceutical space continues to attract attention. It was Shire Pharmaceutical, again FTSE 100 company, listed here in the UK, that attracted the attention of another US company with an indicative approach at around £46. We're expecting during the course of Monday today Shire to be talking on a conference call as to why they have turned down that initial approach, and feelings that they may come back with a higher offer. We launched in the same sector a buy note on a company called Merck. This is the US version of Merck. A company which has quite important exposure to the oncology markets in sort of some exciting new areas of the drug discovery industry. Merck, obviously a major player, significant player in the global pharma, and trading at a small discount to the global peer group. A research note is available with your broker. Good week last week, finally, for Rolls-Royce. After the profit warning from the early part of this year, the company has for some time sort of struggled to sort of convince investors that it has bottomed out its guidance, but did so last week. The trading update was met with full satisfaction from analysts, and the shares were marked up around 7 to 8% on the day, as the analysts felt much more comfortable with the forward strategy of Rolls-Royce. There has been some negative news around Emirates cancelling some engine orders on the Airbus side, but that didn't do any particular harm to the group. They're convinced that they can replace those orders from elsewhere, and the guidance remains sort of quite firm for the future. So that was encouraging and sent Rolls-Royce higher. We've had some stronger data out from China on the manufacturing side. I've been highlighting these miners as not enjoying the party at all. Commodities have been on the decline, and the miners have certainly been on the decline, with stocks like Rio Tinto hitting a year-to-date low very recently, but a very sharp bounce back off those lows again. So it's really trying to find some support at around the £30, £30.50 level on Rio Tinto, quite majorly exposed to the iron ore market, which has been obviously very weak of late. But some Chinese data overnight, manufacturing side, has put a bit of spirit into the miners, and so whilst the FTSE 100 is opening lower today, it is the miners that are topping the sort of upward charts at the moment. So, as I say, it's a sector, it's a bit of an outlier at the moment. It's been a quite markedly underperformer. Just trying to feel my way into working whether we have found some lows on those miners. And finally, just a sort of reminder that we published a recent note on Linde. This is the commercial gases business based in Europe. It really is just reflecting the fact that there has been a little bit more interest recently, particularly from international buyers for European equities, feeling that if there's going to be a pleasant surprise to the upside this year, it will be more in terms of European growth, industrial growth, and as a result of that, we picked out Linde, and those shares have really sort of broken out. There's been quite a marked movement higher in recent weeks on that. So again, if you haven't taken a look at the note, would encourage you to do so via your broker.